Okay, hello everyone. Welcome to our webinar presentation of Purchase Price Variance, Unlocking the Mystery and Enigma that is PPV. We're certainly glad you're here with us today. This presentation should run for about 30 minutes and then will be available on our website for your reference. Today's speaker is Ian Gorman. He's a senior functional consultant here at MCA Connect, and I'll hand it off to him to get this presentation started.
Yeah, so thanks for those who have joined. Again, the session title here is Unlocking the Mystery that is PPV, so Purchase Price Variance. Before we dive into the topic itself, just some quick background. So my name is Ian Gorman. I'm a senior functional consultant at MCA Connect. I've worked on the platform for going on 5 years, mostly focusing on finance and trade and logistics, so supply chain. And I have worked on 2009, 2012, and finance and operations. Quick background, mostly IT project management, followed by ERP, a plethora of certifications, MBA with a concentration in finance, and an IT background again. And the last thing I'll point out too is my email will be listed later on in the presentation, but it's also there on this slide right now. If there's any follow-up questions you might have, you're more than welcome to reach out to me. So getting started. So for session objectives, really what we're going to be focusing on here is how to calculate PPV, specifically in 2012 and finance and operations. We're going to learn how to resolve the errors that you might see around PPV itself. And then I'll provide some lessons learned, seeing as I'm currently a part of the managed services team with MCA Connect. So we've definitely seen a lot of issues around this and common causes. And so I'll provide that kind of background to the group. In regards to PPV and who it impacts, we'll discuss that further. We'll establish which versions of AX the audience is using, which this is more tailored around our summit presentation, so we might not be going into that now. We'll determine how PPV itself is calculated and which variables are in play here and the calculation process. And we'll review the most common issues again with PPV. And I often refer to this as the investigative accountant situation. So this is important for another slide that's coming up here shortly, but I want to remind everyone that this presentation will mostly be geared around 2012 and finance and operations. From my understanding, I didn't really come into this too often in prior versions, but PPV may be calculated slightly differently in 2009 or 4.0. If you're running either of those versions, you're more than welcome to reach out to me if you have any questions. In regards to what is PPV, PPV is purchase price variance, and it's the variance between the actual price paid to buy an item versus its standard cost price. So this is, again, following around purchase orders, since the keyword here is purchase price variance. The formula itself is very simple. It's the unit price on your purchase order minus the activated standard cost on that item itself, and then you multiply it by the quantity. We'll go into more examples here shortly to explain this a little bit further. And in regards to who it impacts, PPV only comes into place with standard cost environments. So if you're running FIFO or LIFO or weighted average, you most likely will not experience PPV. So as mentioned earlier, the calculation process for PPV varies across AX versions. For AX 2012, RTM through R3, and finance and operations, it calculates twice. When a product receipt is posted against a PO is the first calculation, and the second calculation is when an invoice is posted against a PO, and a PO is a purchase order. For my understanding of AX 4.0 in 2009, PPV is only calculated when an invoice is posted against a purchase order. So there was an asterisk on when a product receipt is posted on the last slide. And a product receipt can't have a purchase price variance entry if you disable the product receipts in the ledger. So there's most likely a screenshot here to follow. But within the accounts payable parameters, there's an option for you to remove any GL entries to the ledger upon product receipt. Most customers I work with have this enabled, so they want to see entries flowing back to the ledger itself upon a product receipt being posted against a PO. But just keep in mind, if in your environment this is disabled, you most likely will not see any PPV entries back to your ledger until the purchase order itself is invoiced. So going on kind of quickly here to some sample transactions so we can get an idea for how this is all being calculated. For the calculation process of purchase price variance at the time of product receipt, the formula again is very simple. So on this screenshot right here, we're looking at a purchase order quantity and unit price. The quantity is 1, the unit price is 50. If this item itself, the AXUG laptops, has a standard cost of $100, but was purchased at a unit price of 50, then our formula is as follows: $50 minus $100 times the quantity. So this would be a credit to PPV of $50. So again, it's the unit price on your purchase order minus the standard cost price on that item. Very straightforward, but often can be confusing when we have other variables in play. Moving forward, this other example here listed on the screen is for quantity 1 with the unit price of $100 for the same item, AXUG laptop. If the standard cost itself is $100, then we will not have any PPV entries generated back at the time of product receipt. If we were to look at this at the time of invoice, for example, and the current active cost is $100, but on the invoice itself, the unit price comes out to $125, then we would expect to see a PPV entry once the invoice is posted. And when we're calculating PPV at the time of the invoice, then the formula does not really change much to the way it was with product receipts. The formula itself is unit price on your invoice minus the activated standard cost of the item at that given time. So for this example, we're expecting to see a $25 entry to the PPV account in the ledger. Again, we're looking at the invoice price minus the standard cost price, generating a $25 variance. So that's a good example of both a product receipt and invoice separately. Now, a common question is, what if there is a PPV variance for both the receipt and the invoice itself? So in this scenario here I've listed on the screen, we have a product receipt entry with a purchase order unit price of $500. If the activated standard cost at the time is $100, then we're going to expect to see a $400 debit to PPV. Again, just reciting it, purchase order unit price minus active standard cost is how we came to this conclusion. The second part to this is, what if there is an invoice posted that also has a variance? So the unit price itself is $105 on the invoice, and the standard cost price is $100. In this circumstance, then, PPV generates a $5 debit to PPV, and the total net change is a credit of negative $395, or just a credit to PPV. So it takes the invoice PPV minus the product receipt PPV, and that's how we end up at the net difference. All right, that's a very straightforward scenario. That's assuming there's no sales tax, there's no charges, there's no other roles in play here. So going on to the other examples, like I said, what about sales tax and charges? Since these will essentially alter the invoice price itself. So in this circumstance here, I'm including sales tax. For a product receipt with a purchase order unit price of $500 and a standard cost price of $100, we have the same situation as last time. PPV is calculating a debit of $400. The sales tax itself comes into play upon the invoice process. So I'm going to break this down a little bit more slowly to ensure we don't lose anyone here. If the invoice unit price is $105 and the standard cost price is $100, and the same situation as the prior example, then our PPV calculation on the invoice side is currently $5. However, in this example, we have a 5% sales tax that is being applied to the invoice unit price itself. So in the calculation, we need to essentially get the invoice unit price with tax included as part of our PPV calculation. So in this circumstance here, the invoice unit price with tax comes out to $110.25. If we subtract the standard active cost for this item of $100, the debit amount is $10.25 to PPV. When we're calculating the net PPV entry upon the posting of the invoice, it is the invoice PPV entry minus the product receipt PPV entry. So $10.25 minus $400, which generates a credit to PPV of $389.75. While the formula itself might look overwhelming at first, we just need to understand here that the invoice unit price will need to include tax or any charges that are going to be added at the invoice level. That's the only key takeaway from this point. Moving forward to the next example, which is charges. The same situation plays out. Our product receipt is unaffected. We're still ending up with a debit of $400 to PPV. But at the invoice level is when we see the fixed charge being applied. So we're following a very similar process here. We need to take into account the invoice unit price of $105 and add in the fixed charge to end up at $130. We subtract 100, which is the active standard cost price, and we end up with a $30 debit to PPV. Again, our net PPV calculation is invoice PPV minus the product receipt PPV, which is a credit at $370 to PPV. Now, in every environment, we might have different scenarios at play. These are the most basic ones. If there is a situation where you might have a unique scenario, you need to consider, taking the premise learned here and applying it to your environment, seeing if you can make sense of it. But if you have any issues, again, my email's at the end of this slide, and you are more than welcome to reach out to me. Moving on to common causes and how to fix them. And then the image on the right was just something I quickly put together. Most individuals tend to ignore PPV or blame it on the purchasing department for forgetting to maybe include a unit price in a PO, which we'll discuss more throughout the next few slides. And then, of course, this is a remote session, but at least you're taking the initiative to understand purchase price variance and how it's calculated. And further on through the deck here, we'll talk about how to correct any issues. So one of the most common causes of purchase price variance entries is a missing unit price on a purchase order. This happens more often than you think, and generally, isn't caught until it's too late. But in this example, if the purchase order unit price comes in at $0 and there's a standard cost price of $100, then of course the calculation for purchase price variance is going to result in a negative $100 credit to PPV. This is rather simple to correct. So if you've encountered a scenario where one of your purchase orders is missing a unit price and it has not been received yet, then the quick fix to this is updating a unit price and reconfirming the PO. If there has already been a product receipt posted and you would like to back out the PPV entry itself, then we'll have to cancel the product receipt, update the unit price, reconfirm the PO, and re-receive the product. This isn't essentially, or necessarily a requirement to be done. It is only a process given if you would like to completely back out the entries to your purchase price variance account. I often tell people that if you're catching variances here, it's not really critical to resolve, but it's nice to understand the root causes in the event that there is a change that needs to be done or a training correction that needs to be provided. Moving on, if the inventory was received and used, then if you would like to correct your purchase price variance entry, then you must create a GL journal entry to amend the initial entry from the PPV calculation. So you would either debit or credit your purchase price variance account to offset the purchase expenditure for product account. I don't see any clients of ours often going down this route to remove entries to PPV. More so, it's an account that you would look at in the GL and maybe audit the transactions like stated earlier, just to see if there's any root causes here that you can clear out. It's not necessarily a need to have this account with a $0 balance. So moving on to other causes and lessons learned. I've seen circumstances where a unit of measure under released item record causes a problem, where there might be a conversion between maybe bag and pound, for example, but it's not too often. If you believe you've come across a scenario like this in your environment and you would like some further information, feel free to reach out to me. Another common issue I see is specifically around the 2012 R2 release of Dynamics AX. There are a plethora of costing bugs out there that are published. I believe I have a 6 or 7 page Word document that just lists a lot of hot fixes out there and the issues that they've resolved. So if you're in need of this document, again, feel free to reach out and I'll provide it to you. The third one is the most common situation I've seen, where the PO confirmation date, what happens here is it uses the active cost for the items as of that date. So an example of that, let's say you have an item with a standard cost for 2018 and a standard cost for 2019, and there's a difference between the two. If your PO confirmation is sometime in 2018, then the calculation process will look to see what the active item price is for that specific item or group of items in 2018. It's not so much really a problem here, but you just have to be mindful if your company has multiple costing prices activated over a given period of time. The last one here that we have is customizations around costing. I don't see this too often, but for the circumstances that I have, it's never really fun to debug. You always want to make sure that you vet your costing customizations thoroughly, if you have any, because this can throw off the standard logic of AX. I have seen circumstances where purchase price variance is using the delivery date on a purchase order line detail rather than the standard process for its calculation process. This doesn't really apply to all clients or environments, but it's just something to be cautious of if you're trying to understand or analyze these entries. If you know that you've got some customizations around just the way the system handles costing, this may be a little bit more in depth for you to unravel. So we've talked about common causes and lessons learned. Now we should discuss how to prevent these entries altogether. Again, it's not an indication that there's a significant problem, but it is at least worth reviewing these entries to see if there's any training needs, for example, that need to be done, or if you need to conduct, some other changes throughout the system. First and foremost, the one thing I mentioned quite a bit is that you need to train your users to validate their purchase orders before they confirm them. What I mean by this is, if the unit price is $0, that obviously will cause a problem. So we need to make sure that if that is the common root cause of entries in your environment, that you at least notify your procurement team, as this is a relatively simple process to correct. You also need to maintain accurate and active cost for each of your items. If you're playing with outdated unit cost within your environment, it might be a good sign that you need to conduct a cost roll or start maintaining your item pricing throughout the system. The last one on here on this slide says review entries to the PPV account, investigate the reason, and amend the root cause. So this has been mentioned throughout the presentation itself. Just to reiterate for the 4th or 5th time now, it's not an indication that there's a significant issue. It's just an account that you should be looking at every month to see if there's entries that you can prevent by being proactive. One of the last points I would like to mention here too is that the posting profiles dictate where your purchase price variance entries are going to flow to the ledger from. So in the inventory management module, underneath setup, there's the posting profile section itself. There's a tab there called standard cost variance. And from here, you'll see quite a few variances, but we're just going to focus on purchase price variance. You can specify here the main account number you would like to use. And generally, I see most of our clients using just one main account number. There's no need to have this broken out unless there's a specific requirement from the accounting team. Just good information to know. So as a recap of the session itself, we've reviewed purchase price variance and the impacts. We've established how purchase price variance is calculated in multiple versions of AX. We've discussed the purchase price variance formula and variables involved. So standard cost price that's active at the time and the invoice or purchase unit price. And we went over the most common issues and the resolutions. And as a recap, this last slide is just a reminder, mostly more so for the email at the bottom. So it's ian.gorman@mcaconnect.com. Thank you.
Awesome. Well, thank you, Ian, for that. That was a lot of good information. And thank you, everyone, for spending a few minutes with us during this webinar presentation. Again, this recording will be posted on the MCA Connect website, where you can reference it and share it as you choose. So again, thank you so much to everyone, and we hope you have a wonderful day.